Is the stock market completely disconnected from reality? Today, I'm going to show you the data that suggests we're in a massive bubble, why the real economy is telling a completely different story, and I'll reveal a detailed analysis of a high-quality company that's trading at a price we haven't seen in over a decade. Here's a fact for you. A key indicator that predicted the dot-com bust is now higher than it was back then. And while some AI stocks are trading at hundreds of times their earnings, one household name is on sale. Stay with me to find out which one. Let's start with the big picture. Robert Shiller's indicator, which measures market valuation, is currently at 40. For context, it has only been above 25 during major bubbles like 1929 and 2000. Right now, it's screaming caution. The S&P 500 is trading at 30 times earnings, double its historical average of 16. This is not normal. We see individual companies at even crazier levels. NVDA is trading at over 50 times earnings, AMD at over 60, and Palantir at a staggering 300 times earnings. It's no wonder SoftBank just sold its entire stake in NVIDIA. That's a huge red flag. Now, contrast this with the real economy. The official poverty line in the U.S. is far below what's needed for a decent life, masking the reality that millions are struggling with the high cost of living and housing. There's a massive disconnect between the booming stock market and the financial reality for most people. So, in a market that looks this expensive, where do we find value? This brings me to our main company today, Colgate-Palmolive. While the market hits new highs, Colgate stock has fallen nearly 15% in the last year. It's now trading at valuation multiples we haven't seen in over a decade. This is a classic buy when there's blood in the street scenario for a quality company. And Colgate is quality. It's a dividend king, meaning it has increased its dividend for over 60 consecutive years. This is a business that provides stable income even in a weak economy. Most people think of Colgate as just toothpaste, but its revenue is well diversified. It operates in oral care, personal care, home care, and a hidden gem, pet nutrition through its Hill's brand. This pet segment is a high-growth, high-margin business that is becoming a bigger and bigger piece of the pie. The main threat is competition from cheaper private labels, but Colgate's brand strength is a powerful defense. The company is projecting solid growth and its finances are healthy. Based on its historical valuation and growth prospects, I estimate a fair price-to-earnings multiple of 24 to 25. This gives us a price target of 115 to 120 per share. From its current price, that represents a potential upside of over 50%. Finding undervalued gems like this is key to navigating a tricky market. If you're getting value from this analysis, hit that subscribe button so you don't miss the next one. Now, another high-quality company that looks interesting right now is Zoetis, the global leader in animal health. Much like Colgate's pet division, Zoetis benefits from the trend of people spending more and more on their pets. It's a highly profitable business with margins that look more like a tech company than a healthcare firm. Zoetis has a fantastic track record of growth, it treats its shareholders well with dividends and buybacks, and it's also trading at a valuation that is low compared to its own history. It's another example of a solid, long-term business you can buy at a reasonable price today, especially while other parts of the market look so speculative. We're definitely seeing a rotation in the market, and later I'll tell you why this might favor Main Street companies over Wall Street darlings. Let's quickly check the pulse of the rest of the market. We're seeing some interesting moves. AMD CEO is forecasting explosive growth in its AI division, which has investors excited. On the other hand, there are concerns about Meta's accounting practices and overinvestment, which could hurt its value down the road. FedEx and UPS are showing signs of a rebound, suggesting a potential low-risk, high-reward scenario. And IBM is hitting all-time highs thanks to its progress in quantum computing. The key takeaway is this: the overall market, especially in tech and AI, looks dangerously expensive. The data points towards a bubble. But that doesn't mean you should run for the hills. It means we have to be selective. Focus on high-quality businesses in the real economy that are trading at fair prices. Companies like Colgate and Zoetis offer stability, dividends, and significant upside potential without the speculative frenzy. It's about finding quality, not just chasing hype. If you agree, subscribe to the channel for more deep dives. Now, I want to hear from you. Are you buying the AI hype, or are you looking for value in forgotten stocks like Colgate? Let me know in the comments below.